Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, guaranteed sources of retirement income, part 2 in our series on annuity retirement strategies. Well, welcome to the second segment, and we're talking about how to build this annuity and looking at annuities as a possible source. It's just one source, but it's one that's really undereducated in the public domain, and that's why I like to talk about it, just to make sure you understand what you're up against, what's good and what's bad. I want to think about this. You're looking at my beautiful graphics here that we have here on the train, and you'll notice I have fixed annuities, variable annuities, I have immediate annuities, I have deferred annuities, and I can take it either in single premium or install it under incremental or installment plans. The idea behind looking at annuities in this way is to figure out, when do you need the money? For example, if I knew I needed the money within 13 months, I'm going to look at the single premium immediate annuity payout. I can go on several sites that display this every day and change every day and have almost all the major insurance carriers that play there. And by the way, did you hear I use the phrase insurance carrier? Because annuities are manufactured by life and annuity companies. That's how they guarantee it, using mortality credits. So you can't get manufactured issues like this, especially for lifetime and guaranteed, unless you're using an insurance company, and they're the ones that do the manufacturing of annuities. So I'm looking at single premium immediate annuity, and as the rates start to tick up with the Fed, you're going to see the single premium immediate annuity payout rates also increase. Keep in mind, I might want to defer it though. I don't need the money now. I might want to wait 2 years, 4 years, 6 years. You could actually take that risk off the table and buy a deferred income annuity. That's an income annuity that you use when you don't need the money in the first 13 months, but you do need it maybe 2 years, 3 years, 4 years. You can buy blocks of income in periods certain, but you could do deferred income annuities as well as a guaranteed lifetime payout. Keep in mind, and this is a big subject matter when we get into it in the fifth segment, you'll be able to actually defer some of your RMDs, but the only qualification under the code is using these deferred income annuities. Now, right now, a lot of people always ask me, Steve, I want to buy an annuity for the rate. I hear that the rate, the actual interest rate guarantee, whether it's 3 years, 4 years, 5 years, 7 years, 10 years, that those rates are generally larger or greater than certificates of deposit. You need to go out to bankrate.com to check that out to see if that's true. Again, there's several annuity sites that are out there that will quote a rate, so you can compare the bank CD and their 5-year rate as an example to an annuity 5-year lockdown rate. And right now, it seems that the annuity pays out a little bit more. Remember the two things you get. In a non-qualified scenario, a CD, I have to pay taxes every year whether I use the money or not. An annuity, I get to defer those 5 years of earnings until the time of the period certain is over. So there's a little bit of economic value by deferring the taxes on that. So you just have to start thinking, hey, should I keep it? And if you didn't need the money at the end of the 5 years, you might be able to roll it over and have no taxable event. So it's very important if you're buying a rate, especially in these days, a lot of what we're doing is we see interest rates ticking up, so we're doing what's called a laddering effect. We're using 3 years, 4 years, and 5 years. Right now, I'm not really a fan of 7 or 10 years. The little bit more you get is not worth it. I think over this next 5 to 10 years, we're going to see interest rates slowly tick up, and I just want to be able to keep doing 3, 4, and 5 year lockdown guaranteed rates. Again, if the banks are bigger, I'm going to switch over to CDs. So you have to determine what you want out of an annuity. Is it guaranteed income for life, or in this case that I just spoke, I'm talking about actual rate, guaranteed rates, so I can save and hold. Now, when I'm looking at this, I could be variable. Now, that's in the market. Keep in mind, there's expenses to this. And if I was maybe a young person and I had a high degree of risk tolerance, I might look at it. Because remember, this is a market-driven contract, so you could lose money. So be advised, you have to have the risk tolerance, the kind of idea of long haul horizon to make this work for you. And again, it has a little bit, in my view, has some expense loads. It might be good for deferral, but I don't know if I'd be buying it with the income rider. You have to look at everything as what its forte is. In this case, I'm putting all these mutual funds and I'm deferring them because I already have money tied up in my qualified plans and I can't put any more money in it. That'd be one of the reasons I'd look at it. So you'd have fixed rates, you have variable annuities, which could be all over the board. You have MIGA rates. These rates can change during the course of when you're holding your annuity. You're hoping that the changes are good, so if they go up, you're going to gain. If they go down, you could lose. Just got to be careful what you're getting into. If you're just saying, Steve, I just need a flat rate, again, fixed rates are the way to go. You could do this as a single premium income, or you could also do it as an installment or an incremental savings. And keep in mind, a lot of people like indexed annuities now because they can participate in an index. It could be domestic, it could be foreign. The S&P 500 is chosen over 70% of the time to fund indexed annuities. And they also come with possibility of buying an income rider. Generally, that costs you about 75 to 125 basis points. You have to determine if it's worth it. So it's only insurance for you because at the end game, you're going to be able to look at everything. Before I trigger income on an indexed income rider, I would always look at the single premium rate, the deferred income rate, and then the income rider. Which one is going to pay me the most? Whoever wins, that's who I'm going with. Remember, index is really great. We don't participate in the S&P 500. In my example, we don't. You don't get the dividends, but we also don't get the loss. It has a protection or a hedge beneath the actual floor of zero. So I'm protected. I can't get less than zero. Now remember, if you have expenses on your income rider, or you have any other expenses on that annuity, and you had a 0-year crediting, you'd actually lose a little money because there's bills to pay in the contract. That's why it's good to weigh out all expenses, look at them across the board and be agnostic. We don't care which one you choose. We want it to be suitable. We want the risk tolerances to match up, and we want to look at the actual cost of the actual annuity to see which one we should do. It's important always to look at also, is this annuity going to be in qualified money or in non-qualified money? As an example, sometimes you can convert qualified assets into an annuity that's joint for you and your spouse. When you do that, you may want to put a cost of living rider on it so that every year you're going to get a small bump up. The positive is, over the long haul, and especially if you have longevity in your family, that'll be a good thing. But in the short term, the actual rate of return or the income itself kind of is dipped down. If I can save money on taxes under my RMD because I'm taking a little less so I can have that increase every year, if I'm getting a tax savings on my RMD, required minimum distributions at 70.5, and I'm also then saving a little money on my Social Security taxation, because remember, keep in mind, all qualified plans are going to be includable in the provisional income test of Social Security and could tax your Social Security. If I save on my Social Security taxes and my RMD taxes, the actual dip or buying a COLA may be worth the while because I'm using taxes to pay for the early years when it's a lot less. Now I want to show you going to the next page of our book. We're talking again about qualified versus non-qualified. And remember, I like a mix of taxable diversity, right? So is it taxable? Is it tax-free? Is it tax-deferred? I like them all, and I use them all because I want to manage my tax bill during retirement. The more I understand that and can really get my hands around it, the more money I'll be able to pocket, and I'll be able to keep my tax liability low. Think about it, seniors, with the new tax code, we have $24,000 standard deduction and another $2,500, $2,550 for being 65 or older. So we're already at $26,500 at the get-go. I love that because that is a huge boon for most seniors. Haven't figured this out yet, and it could be a monster idea for them because it's just us two left. Wow, that's great. Standard deduction at $24,000 and the extra bump for being over 65. So that tax bill is going to harbor, that means that you can shelter about 25, 26 grand every year of taxable income. So now I want to say, hey, I'm going to try to figure out what my income can come in, how much I need, and then I'm going to try to match up my standard deduction. Now remember, some people are going to itemize, but I'm saying most Americans and seniors won't have to do this anymore. So they're going to go and choose how much income do they have to take from their qualified plans and match that up, and then take their Social Security with the rest. Keep in mind that all forms of income, except for 4 ideas, will actually be includable in your Social Security. So it's a very important issue. Those issues are HSA accounts, reverse mortgage, cash value life insurance, and Roth IRAs. So the only 4 that don't or are not includable in Social Security. So just keep in mind, when you're putting your plan together, you want to look at qualified versus non-qualified so that you can keep more of your money for your retirement and keep your lifestyle in retirement to where you want to do so you can enjoy it. Don't forget to watch our next segment on fixed rate and indexed annuities, part 3 in our series on annuity retirement strategies. And keep in mind, before moving forward with any of the ideas you hear on our show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money, the name of the game.